For example, I had a friend who was like saving for a house and suddenly just he woke up and there's just, like half of his house savings are like gone in purchasing power terms. And then now they're going through the same thing again, where they had a really sharp, it was a three-step so far, a three-step currency devaluation. It was kind of a plan. It's basically like, they eventually had to do it, but the central bank did it on a timing that they kind of pulled the Band-Aid off. And so you had these stepwise devaluations. And so you go from like 15 Egyptian pounds to the dollar to 30 Egyptian pounds to the dollar in a very short period of time. I'm hopeful that some of this, the rate of this happening is behind us.
In a tweet a few days ago, Lyn Alden points out that the government has been spending more money than it is taking in, and this has caused the Treasury's cash account to decrease by over $600 billion since the middle of 2022. This decrease in cash has added more money into the financial system and has offset the Federal Reserve's efforts to take money out of the financial system during the same time period. This situation is likely to continue into the spring due to a disagreement over how much money the government should be allowed to borrow. In this video, Lyn Alden is discussing the issue of countries, particularly emerging markets, having a large amount of debt denominated in foreign currencies, mostly in dollars. This can lead to currency crisis or debt crisis when the value of their local currency drops rapidly against the dollar. Countries like Argentina, Turkey, and Egypt have experienced this in the past. Lyn Alden also discusses how this issue is further exacerbated by the actions of developed countries and global institutions like the IMF, World Bank, and the China Belt and Road Initiative. She also mentions that in countries with monetary problems, people are more likely to adopt crypto, such as Bitcoin and stablecoins, as a way to store their wealth. However, usage of crypto is still relatively low in countries like Egypt. Before we proceed with the video, please take some time to like this video, subscribe, and make sure to leave any comment or questions in the comment section.
Last time we saw the developed world go through like a period that's like now where you have like over 100% debt to GDP was like the 1940s. And you had very high debt levels. And what a lot of them did was various types of financial repression, which includes yield curve control. So for example, the United States the Federal Reserve did yield curve control, where they say, okay, we're not going to let, in addition to controlling the short end of the curve, we're also going to not let the long end of the Treasury curve go over a certain amount. And for the United States, that was 2.5%. So inflation averaged something like 6% from the early 40s to the early 50s. It spiked as high as 19%. But they held short-term rates near zero. They held the long end at 2.5%. And the way they do that is they say, we're willing to print money and buy any bond that trades over that yield. Or putting it another way, because bond prices are inverse to yield, any bond that tries to go below a certain price, we're going to buy. And essentially what they try to do is train the private sector to do it for them, because private sector comes to know, if they start to view that as credible, like let's say the yield goes to 2.6%, JP Morgan could come and buy that, knowing that if it stays above 2.5% for any length of time, they'll be able to sell it to the Fed, and they'll be able to make this basically risk-free profit, assuming the Fed actually, sticks by their yield curve control target. And of course, that ends up inflating away a significant part of the debt because you hold the yields below the inflation rate with basically a limited QE as needed to do it. And so fast forward to the modern time, it's, this is the first time since then where we see a lot of developed countries with well over 100% debt to GDP, and Japan's is the highest at over 200% debt to GDP. So they have a very, very large sovereign debt load, and they can't afford significant interest rates on their debt. And they also want to maintain very easy monetary conditions, despite the fact that inflation is above their target. And so they've been doing, for a while, they were holding their yields at 0.25%. So the 10-year yield was at 0.25%, even though the rest of the world was hiking their interest rates, even though Japan's inflation was above their official target, they were still holding that really low. And they had to buy quite a lot of bonds in order to hold that at that level. A little while ago, I forget how long ago it was now, time flies so quickly, but they kind of overnight, they expanded that to 0.5%. So they basically let the yields go a little bit higher, 0.5%, which is still below the prevailing inflation rate, below the inflation rate target. And so it's kind of, first of all, it's relevant on a global scale because it's kind of like a canary in the coal mine. We're seeing how some of these very indebted countries can handle this, basically see how hard is it to do, what are the pitfalls that central banks might run into when trying to implement this policy. It certainly wasn't easy in the 40s, and it's not been easy for Japan here in the 2020s. But it's also relevant on a global scale for other reasons. One is that, aside from being very indebted, Japan has a very positive net international investment position, meaning that they had decades of current account surpluses, and they use those current account surpluses to go and buy foreign assets. So they own, $1 trillion worth of treasuries, the biggest treasury holder, external to the United States. They go out and buy US stocks. They go out and buy European stocks. They go out and buy commodity deposits and things like that around the world. They own a lot more foreign assets than foreigners own of Japanese assets. And, basically when they start to run into a currency crisis, one thing they can do, in addition to manipulating yields and things like that, they can also sell off some of those foreign assets, especially ones that are owned by the central bank, owned by official accounts. And so and then a third thing is that because their rates are so low, a lot of foreign entities have used them as a funding source to then go out and buy foreign assets. And so often what you'll see is that, when US interest rates are also pretty low, you'll see that a lot of Japanese investors will go buy treasuries, and then they'll hedge them back and, to take out the dollar risk compared to the yen, and they'll still get a better yield than they can get on their local currency. But lately, because the US interest rate has increased so much, if a Japanese investor wants to buy US treasuries and they want to hedge out the currency risk, that's actually a lower FX hedge yield than what they can get in Japan. And so basically this can kind of ripple through the rest of the global bond market. Part of why they've been able to stay so low is because Japanese yields have been so low. And so this is kind of like a real-time experiment, for the first time in many, many decades, to see a very, very large developed country try to artificially suppress essentially its entire yield curve below the prevailing inflation rate and all the pitfalls that come with that.
Lyn Alden also discussed the concept of yield curve control, which is a monetary policy tool used by central banks to control the interest rates on government bonds. The idea is to keep short-term rates near zero while also capping long-term rates at a certain level. This is done by the central bank printing money and buying bonds that trade above the targeted yield in order to push the price of the bond up and the yield down. She also talks about the CPI rating and how they have been some sort of misunderstanding on the new method of calculating the CPI, indicating that there won't be any significant fall in inflation rate.
Generally, one thing you see historically is that when the dollar is going up very rapidly, because there's so much dollar-denominated debt out there, you'll see a lot of entities sell treasuries or other dollar-denominated assets to get dollars to then service their debts. And one thing people forget is that, a lot of people mention this $13 trillion debt figure, but they forget to mention that there's over like $50 trillion worth of US assets held by the foreign sector. And so they have way more assets in aggregate than they have liabilities. And obviously that depends on the jurisdiction. So for example, Turkey has more liabilities than assets. So they're more stuck, whereas an entity like Japan has way more assets than liabilities when it comes to the foreign, dollar denominated variety. And so if you're trying, basically the hard part about yield curve control is that if you're trying to manage your yields artificially, the release valve is the currency. So if you hold the yield artificially low, you're going to get your currency weaken more than it otherwise would. But then the third variable they can do, if they have a lot of reserves, is they can also then sell some reserves. And so instead of weakening the currency, they can lower their reserve balance. But then that can damage the asset that they're selling, which in this case might be treasuries. The US dollar peak coincided with a bottoming in domestic liquidity. So the market started to price in slower rate hikes from the Fed, which has so far been somewhat materializing. And then also the Treasury general account has drawn down. That gets pretty jargony, but essentially that the Treasury's kind of been partially offsetting some of the QT that the Fed's been doing, possibly in partly in response to this upcoming debt ceiling issue. And so at least temporarily, there's slightly improved domestic liquidity. And then the weaker dollar is giving that global liquidity a little bit of a boost. And so I wouldn't say that all of that's due to Japan, but certainly Japanese selling of treasuries is easily a potential variable to that, because, anytime that a large amount of foreign assets get sold from the US, that can cause problems. We've also seen, for example, Switzerland, a lot of these other ones will just stop buying some US equities and stop buying some US assets that they were just endlessly piling into, which is now somewhat reversing. The challenge of measuring in inflation is that everybody's inflation basket is unique, right? So for example, the weight that I spend things on is different than the weight that you spend things on, which is different than the weight that Alyse spends things on. And so all of us have like our own unique inflation basket. Like one of us travels way more than the others and travel prices are soaring. Another person, spends more on eating out, and that is, say, not soaring, let's say. then we can have different experiences of how inflation is impacting us. And so what CPI tries to do is it tries to take like a nationwide average of what is the average basket that the average consumer is buying, right? So what percentage of their expenditures go towards shelter? What percentage of their expenditures go towards transportation? What percentages go towards food? And they try to construct this like, quintessential American, person. And they say, what is their inflation rate like? And there are various ways to tweak that. But essentially what this change is going to do is make that basket update more frequently, which sometimes can cause inflation to come out even hotter than it was before. And other times can cause inflation to, be lower than it otherwise would be with the prior calculation. Basically, if you update the basket every 2 years versus every 1 year, you get slightly different results, even if you're still looking at year over year CPI. And so I don't think we're going to see a giant drop right away, but it certainly can affect the numbers around the margins.
So do we speed it up as it's going down and slow it down as it's going up? Is that what I'm hearing?
Well, one example was
I'm joking.
so during COVID, for example, people stopped buying a lot of services. They stopped flying. They stopped eating out. They started buying more electronics. They started renovating their home. They started, doing things like that, buying the consumer durables. And then once the lockdowns ended and some of the travel restrictions eased, you saw basically people already bought all the home stuff that they want for the next couple of years. And instead they started flying more and going to hotels more and eating out more. And so you kind of saw that rolling inflation go from those consumer durables to then go to services. And so if you're looking at the basket, how far back you go can impact. If we're spending more on services now, then services are going to have a higher weighting in CPI versus if we go back farther and include that period where we're all buying durables, goods.
Additionally, the Lyn Alden highlights the potential impact of inflation on the economy and the potential effects of rising consumer prices on consumer spending. Overall, the video presents a simple and interesting view of the current economic situation in global markets and its potential impact on the global economy. You can drop any comment or opinion you may have and endeavor to like this video, subscribe, and turn on notifications. Thanks for watching.